Passive income, right? That's the new buzzword. We live in a society that is obsessed with passive income and the idea of making money while you sleep, so to say. And one of the ways that you do that is by potentially investing in stocks that pay you a dividend, and you can live off of these dividends for the rest of your days and just kick up your feet and relax, right? After all, that's how the super wealthy do it, right? Well, there's a lot of misconceptions around dividends, and we're going to break all of that down for you today. So first and foremost, let's answer this question. Should you even care about dividends? And the answer is yes, 100%. You need to care about dividends. You need to understand dividends, because what you're going to find out is that dividends play a crucial role in the return of an overall portfolio. But how much you should care, that's the million-dollar question. And this is where a lot of people end up taking a turn for the worst and doing some really wonky things. So if you're not familiar with what a dividend is very simply earnings that a company generates, right? So just envision this: a company is making profits and they're starting to pile excess cash, right? So this company that's generating all this excess cash, they could in theory take that cash and reinvest it back into the company to spur further growth, or they could reward shareholders of that company and pay out a dividend. So the idea becomes, what if you just invest in a bunch of companies or an ETF that pays out lots of dividends, right? If you were to do that, couldn't you just live off of all these cash payments that these companies are paying you? Here's the issue. When people learn about dividends, it generally goes one of two ways. You get the folks that are absolutely obsessed with this concept and they chase it, right? They're the folks that are going on Google and typing in, what's the highest dividend yield stock or ETF, right? They're the people that go on Reddit and they talk about ETFs that are paying 12, 13% dividend yields, right? I mean, those are the type of people that we're talking about. They get obsessed with chasing dividends. On the flip side, you get people who are like, well, I don't need that cash, right? I'd much rather pursue growth, right? What if I wanted to invest in a tech company that is really involved in AI, for example, and they need that cash to reinvest back into the company to further pursue their venture into AI, for example, right? I'd much rather pursue that because that's going to result in better returns, right? I don't need dividends. I want that. Here's the reality. About 1/3 of the S&P 500's historical returns have come from dividends, right? So if you strip dividends out of that equation, you have 1/3 less money in your pocket over the long run from the S&P 500. So you can see why somebody like Warren Buffett is such a diehard value or dividend investor. He fundamentally understands the importance of a company that's generating really, really good cash flow and rewarding their shareholders. But on the flip side of that, right, we said that dividends is 1/3 of the S&P 500's total return. What about the other 2/3? Well, that other 2/3 is just simply capital appreciation, right? So over the long run, you need both to truly optimize returns. You see how that formula works? You have some of the return being derived from dividends and the other portion of the return being derived from capital appreciation or growth. So the reality is that you generally need both to coexist within the same investment portfolio to optimize your returns. And this isn't a, revolutionary idea. This is the concept of total returns, right? A total return approach to investing means that when you are trying to generate income or long-term growth, that you're pursuing a combination of dividends, maybe interest from bonds, money market CDs, whatever, capital appreciation. And when you combine all of that together, that creates a very effective, diversified portfolio. So this is how it could potentially play out in real life. You could have someone in their 30s with a retirement portfolio, and in their retirement portfolio that they don't need to touch for another 20, 30 years, they're investing in a combination of exclusively stocks, let's say, that maybe some of those stocks are more dividend oriented, maybe other ones are more growth oriented. And when you combine it all together, they get this total return portfolio. On the flip side of that, let's say you get somebody who's, in their 60s and they're looking to retire and they're looking to live off of their investments. Well, rather than just simply chasing dividends, which we know historically is only 1/3 of the S&P 500's returns, maybe they have a combination of dividends supporting their income in retirement, but then they also have growth, capital appreciation, and maybe they're trimming a little bit of the growth of their portfolio every year in combination with the dividends to sustain their income needs in retirement, right? So you can see that total return approach play out for even a retiree. So if there's anything that you get from this video, it should be two things. Number one, you should care about dividends, right? You absolutely should care about them, and you should fundamentally understand how they play a part of your overall investment strategy. But you should also understand what a total return approach is. You should understand that dividends generally are just one piece of the puzzle. Because here's the reality, right? A lot of folks right now, they're obsessed with the idea of dividends. They're obsessed with the idea of just living off of passive income. And so they're chasing it. They're really skewing their investments to just simply dividends. And without going into all of the complexities of that, if it were really that simple, right? If it were really as simple as Googling, what's a stock or an ETF paying over 10% dividend yield? Don't you think we'd all be rich right now? We'd all be multimillionaires if it were really that simple. The reality is it's not that simple, right? Just because a stock or an ETF is paying a 10, 11, 12% dividend yield doesn't necessarily mean the return is going to be 11, 12%. What if the return sucks? What if the return is actually going down, right? Sure, you're getting that 11, 12% dividend yield, but is it making up for the fact that the stock or the fund itself is a dud? Maybe not. If you like this content, go ahead and subscribe to our channel. In the description of this video, we have a link to our weekly newsletter where we talk about everything from taxes, investing, retirement planning, and more. You do not want to miss it. And of course, if you need more one-on-one advice for your own portfolio, feel free to reach out to us at modernwealth.com.